If you are retired and you have money sitting in a bank account right now, there is an IRS warning that you absolutely cannot afford to ignore. We are talking about a potential penalty of up to $10,000, and the frightening part is that thousands of retirees are triggering this penalty without even knowing they are doing anything wrong. This is not about tax fraud. This is not about hiding money. This is about perfectly normal, everyday banking activity that has quietly crossed into a legal reporting threshold that the IRS takes extremely seriously. If you have a savings account, a checking account, a money market account, or any other bank account with regular deposits or withdrawals, you need to watch this video from start to finish because what you learn here could save you from a massive financial penalty that would devastate your retirement savings. Welcome to SSA Benefits Alert, the channel dedicated to helping retirees, Social Security recipients, and seniors across the United States navigate the complex world of benefits, taxes, banking rules, and financial regulations that directly affect your retirement security. Every single week, we bring you critical updates and warnings that the mainstream media often overlooks, because we believe that every American who has worked hard their entire life and earned their retirement deserves to have access to clear, honest, and practical information. If you are not yet subscribed to SSA Benefits Alert, hit that subscribe button right now and turn on the notification bell so you never miss an alert that could protect your financial future. Now, let us get into the heart of this warning and make sure you understand exactly what is happening, why it is happening, and most importantly, what you need to do about it. The penalty we are discussing today is connected to a federal law called the Bank Secrecy Act, and it involves a process called currency transaction reporting combined with something called structuring. These are terms that most retirees have never heard of, and that is precisely the problem because not knowing about them does not protect you from the consequences of accidentally violating them. Here is how this works. Federal law requires banks to automatically file a report with the federal government anytime a cash transaction exceeds $10,000 in a single day. This report is called a currency transaction report, and it goes directly to the Financial Crimes Enforcement Network, which is a bureau of the United States Department of the Treasury. The purpose of this law was originally designed to catch drug dealers, money launderers, and organized crime figures who were moving large amounts of illegal cash through the banking system. That was the intent. The problem is that the law applies to everyone, including honest, law-abiding retirees who have no connection whatsoever to criminal activity. Now here is where it gets even more serious, and this is the part that catches so many retirees completely off guard. There is a related federal crime called structuring, and structuring occurs when someone makes a series of transactions that are each individually below the $10,000 reporting threshold. But the pattern of those transactions suggests an intent to avoid triggering the automatic bank report. In other words, if you consistently make deposits or withdrawals of $9,500 or $8,500, or any amount that appears to be deliberately kept just under the $10,000 limit, the IRS and federal investigators can and do treat that as a violation of federal law, even if every single dollar in those transactions came from completely legitimate sources. The penalty for structuring, even unintentional structuring, can reach up to $10,000 per violation. And in some cases, federal authorities have pursued civil asset forfeiture, meaning they have actually seized entire bank accounts from people who were never charged with any crime at all. This has happened to retirees. This has happened to small business owners. This has happened to farmers, to restaurant owners, and to ordinary Americans who had absolutely no idea they were doing anything that could attract federal scrutiny. The IRS and federal prosecutors have in recent years faced significant criticism for pursuing structuring cases against people with no criminal intent, and there has been some reform in how these cases are handled. But the law itself remains on the books, and the risk remains very real. So what kind of bank activity actually puts retirees at risk? Let us walk through some of the most common scenarios that we see triggering problems. The first scenario involves retirees who regularly withdraw cash from their bank accounts to cover living expenses, pay for home care, give cash gifts to grandchildren, or simply because they prefer using cash over electronic payments. If those withdrawals happen to fall into a pattern where they are regularly just under $10,000, that pattern can attract attention even if the retiree has a completely innocent explanation for it. The second scenario involves retirees who receive large irregular deposits, such as proceeds from selling a home, an inheritance, a lump sum pension payment, or the sale of a vehicle or other valuable asset. When these deposits are combined with regular Social Security or retirement income deposits in the same account, the transaction patterns can become complex and sometimes flag automated monitoring systems. The third scenario, and this one is particularly important for retirees who are helping family members financially, involves making multiple transfers or cash withdrawals to help adult children, grandchildren, or other relatives with their expenses. When a retiree is regularly pulling money out of their account to help family, the cumulative amounts can easily reach levels that attract banking compliance attention, and without proper documentation of what those transactions represent, it can create serious problems. The fourth scenario involves retirees who still have business income, rental income, or freelance income alongside their Social Security and pension payments. The combination of multiple income streams flowing into a single bank account can create transaction patterns that look unusual to automated monitoring systems even when everything is completely above board. It is also critically important for retirees to understand that banks themselves are required by law to report suspicious activity to federal authorities, and that banks have their own internal compliance systems that flag transaction patterns automatically. Your bank does not need to suspect you of a crime to file a suspicious activity report. They simply need to identify a transaction pattern that their compliance software flags as potentially unusual. Once that report is filed, you, as the account holder, may not even be notified that it happened. This is one of the most unsettling aspects of the current banking compliance environment for retirees who simply want to manage their own money without interference. So what can you do to protect yourself? There are several practical steps that every retiree should take in light of this IRS warning. The first and most important step is to be aware of your own banking patterns. Take a moment to look back at your transaction history over the past year and ask yourself whether there are any patterns in your deposits or withdrawals that could be misinterpreted. If you regularly make withdrawals or deposits that are just under $10,000, not because you are trying to avoid anything, but simply because that happens to be the amount you need, consider whether it makes sense to slightly vary those amounts or to consult with a financial advisor or tax professional about how to structure your banking activity in a way that is clearly above any compliance concern. The second step is to document everything. If you are making large cash withdrawals to pay for home care, medical expenses, home repairs, or to help family members, keep a clear written record of what those funds were used for. If you sold an asset and deposited the proceeds, keep the documentation of that sale readily accessible. Good documentation is your best protection in the event that your banking activity ever attracts scrutiny, because it allows you to quickly and clearly demonstrate the legitimate source and purpose of every transaction. The third step is to consider whether your banking structure makes sense for your current situation. Many retirees are still using the same single bank account they have had for decades, depositing all of their income and covering all of their expenses from one place. Depending on your financial situation, it may be worth speaking with a financial advisor about whether using multiple accounts for different purposes, such as a dedicated account for Social Security deposits, a separate account for investment income, and a separate account for discretionary spending, might make your overall transaction pattern cleaner and easier to explain if questions ever arise. The fourth step is to be proactive about your relationship with your bank. Many retirees never speak directly with a banker about their financial situation, and that is understandable. But having a clear relationship with your branch and making sure that the people managing your account have context for your financial situation can sometimes make a meaningful difference in how unusual transactions are interpreted internally. This does not mean you need to explain every withdrawal to your bank, but if you know that you are about to make an unusually large withdrawal for a specific purpose, a brief conversation with your banker documenting the reason can prevent unnecessary complications. The fifth step, and this is perhaps the most important one for retirees who already feel concerned that their past banking activity might have attracted attention, is to consult with a tax attorney or a certified public accountant who specializes in working with retirees and seniors. If you have received any correspondence from the IRS or from your bank about your account activity, do not ignore it and do not try to handle it alone. The laws surrounding currency transaction reports and structuring are technical and complex, and having professional guidance is absolutely essential if you find yourself in a situation where your banking activity is being questioned. We want to be very clear about something important. The vast majority of retirees who are watching this video have absolutely nothing to fear as long as they are aware of these rules, they are documenting their transactions appropriately, and they are not deliberately trying to avoid reporting thresholds. The IRS warning we are discussing today is not a reason to panic. It is a reason to be informed and to take sensible precautions. Knowledge is always your most powerful financial protection tool, and that is exactly why SSA Benefits Alert exists. The retirement years should be a time of security, peace, and the enjoyment of everything you worked your entire life to build. Financial penalties and banking complications are the last thing any retiree should have to deal with. And the best way to make sure you never face them is to stay informed, stay organized, and never hesitate to seek professional guidance when you are uncertain about how the rules apply to your specific situation. Thank you so much for watching today's video here on SSA Benefits Alert. If this information was helpful to you, please take a moment to give this video a thumbs up and share it with a fellow retiree or with a family member who handles finances for a senior loved one. Subscribe to SSA Benefits Alert if you have not already done so, because we are constantly monitoring IRS updates, Social Security changes, Medicare news, and financial regulations that affect your retirement, and we make sure you always have the information you need before it becomes a problem. Stay alert, stay protected, and we will see you in the next video right here on SSA Benefits Alert.